Right. I'm a consultant by background, and I produce research on financial services in various different areas. And recently I've been looking at fintech, financing, performance, and valuation. We've studied 91 fintech startups in the UK across a range of verticals, B2C and B2B, companies which have received at least 2 rounds of financing, so they are slightly more successful in the broader universe. Published a report which came out about a month ago with KPMG and Google Cloud. There's a link there which you can get. So for the sample, we looked at 91 companies who've raised a total of 4.1 billion, with the latest valuation of 13 billion sterling and cumulative losses of 1.1 billion. First round investment for this sample is first external round of financing, 330,000, and this is a median value. And for that level of investment, typically companies give away 20% of the equity, and there are about 381 days between funding rounds. This is a typical progression of financing over 4 rounds using the median values, going from the first round up to the 4th round, where companies are raising 4.8 million, the median value again, 22.4 million valuation. What we found is that companies are continuing to lose money as they go through the first 5 years. The losses are increasing on that profile. This is across the sample. We only have 6 companies out of the 91 which are breaking even or profitable, and for the 17 companies reporting for more than 5 years, 76% of them are still increasing their losses, and only 18% are decreasing their losses. Revenue performance is also slow. The median value after 5 years for those companies who are reporting revenues is 12.6 million. You can see the revenues of those companies on the right-hand side there, so ranging from 35.6 to 1.7 after 5 years of performance. Performance by vertical is something we've looked at. There's loads more detail in the report, by the way, so I'm trying to do this very quickly. Banking tech is the worst sector in terms of losses, and that's driven by the digital banks, where the losses are the highest, and I've shown Monzo as an example here. So very high losses even in year 3. So that's the digital banks that are driving that. But the valuation and returns are extremely good for early stage investors. So the average or the median for the IRR for the first round investors is 82%, 7.1 times multiple from the first round. And these are the highest IRRs for companies who are raising for at least 3 years, Revolut, Monzo, etc. at the top. The problem is that the returns for the later stage investors are much lower. So just to quickly summarize this slide, because it will take ages, if we just look at the last round of financing and the IRR from the previous round, it's much, much lower for the oldest companies. For the 10 oldest companies in their latest round, it's only 14%. So the uplifts in the later rounds are very low. And if you look at something like Funding Circle, you can see where that's a problem. With the early rounds at very low prices, higher prices on the later rounds, an IPO price up at 4.4, and the current price down at 2.42. So all of those earlier rounds, so the later rounds, are either underneath the current price or just about the current price. So apart from the early stage investors, nobody's actually made a lot of money out of Funding Circle. And the other big theme that we looked at, corporate investment trends, which are obviously important. So 38% of the companies in our sample have corporate investment. And in fact, in the last 6 months, that's increased to 60% for those companies that are raising financing. So that's an important trend. So that's a really quick snapshot, but happy to take questions and talk outside about the detail.
Thank you. Any questions for Michael?
So hi, Derek from PaySme. So what you've shown there, I've been saying for about 5 years. I used to run a hedge fund for 17 years.
Okay.
And I've been analysing the financials of all of these companies and saying that they can never make it. So what we're in at the moment is a bull market past the parcel. And as long as somebody can pass the parcel early to the next one, to the next one, to the next one, the people that are losing out are the real investors or the long-term investors who are coming at the end. And this is actually what's going on in the entire industry, in my opinion, and I've been watching it unfold for years, and it's not actually getting any better because the funding rounds are getting bigger and bigger and the cash burn's getting greater. I don't know if that's your observation. So that's the question. Is that your observation? They're burning more cash, and as they grow, they're losing more money?
Yeah, it's difficult to generalize, I have to say, but I mean, that across the sector, that's probably correct. I mean, the later stage investors in some of these companies are, they're grown-up people. I mean, they should know what they're doing. They can also protect themselves to some extent with ratchets and liquidation preferences and that sort of thing. So that gives them some protection. But where the exit comes from, if you're a loss-making company and you're still losing money after 7 or 8 years, I know this is a hot topic at the moment after the flotation of Uber and some other companies, but Funding Circle managed to achieve it. But given what's happened to them since, I mean, I wonder in the fintech sector, certainly in the UK, how easy it's going to be for loss-making companies to IPO with these sorts of issues.
Hi, it's Peter from Edge Fund. Do you have any plans to look outside of the UK, at the stats outside of the UK?
For me, it's a bit difficult in terms of accessing the data. So at the moment, no. But maybe with working with KPMG, I can do that. But I think the UK ought to give a pretty good reflection of what's happening generally. China, of course, is something that's a beast unto itself, so it's difficult to compare with other countries. But certainly with Europe and the US, I think the UK should be quite reasonably reflective.
Hi, I'm Lucy from Brown Jacobson. I just wondered, obviously the values we've seen here are the medians. Was there anything in particular you noticed in those that were having better success, that they were doing different that you didn't particularly expect, or anything that you did that you thought could be applied more widely that would increase the chances of a company having growth, particularly slightly later on when you said that losses were higher? Yeah,
that's a good question, and part of the continuing research is to look at the successful cases, to look at the critical success factors. The 6 companies who are breaking even have very different characteristics, so it's quite difficult to generalize. I think TransferWise is a very interesting case because they're breaking even with a very low margin business model, but they've achieved scale and manage that in a sensible way. So they've at least got to break even without, they have incurred losses over the first 5 years, but they have got to break even after 6 years. There are others like ClearScore, which is quite an interesting case, which almost had an exit to Experian, but that was blocked. But they got to break even after 3 years with 20 million of revenues. So it's almost like a perfect business plan achievement. Highly experienced management team, one of the founders of Capital One, and they also got to scale quite quickly and cracked the cross-selling model. So they got 6 million users and were able to cross-sell into that 6 million user base, which I think is what a lot of other people are trying to do. So I think that one's worth looking at. There are, another one I've got in here is called Blue Motor Finance, which is really a niche business, so it's sort of almost under the radar, providing interesting tech and lending to car dealers. So not very sexy and very low profile. It's not going to be a huge billion-dollar company, but it's profitable. after 3 or 4 years. So, you know, there are some cases that you can look at.
Michael, thank you very much.